Hey, good afternoon, everyone. Welcome to today's webinar, Common Startup Mistakes, provided by Early Growth Financial Services. My name is Jason Kennedy. I will be your guide today as we move through this webinar. A couple of notes, a little housekeeping before we get started. This presentation with Q&A will take approximately 60 minutes. We will go through the presentation and take some time afterwards to field any questions from the audience. You can use the questions pane in your GoToWebinar console to submit any questions you might have. We'll get through as many questions as we can during the duration of the presentation. Any we can't get to, we'll have our contact information on the very last slide. So you can reach out to us and we're happy to help you guys out. A recording of this presentation will be made available within 48 hours of the conclusion of the webinar. You'll get that to you automatically in an email. We'll also have it up on our YouTube channel. That is for the username Early Growth FS. So you can check that and all previous webinars that we've done stored as an archive of sorts on our YouTube channel. So I encourage you to check that out. So with the housekeeping out of the way, let's jump in and I will introduce you to our presenter today, Sirk Roh, Principal and Consulting CFO of Early Growth Financial Services, based out in the Bay Area. Sirk, welcome aboard and say hello.
Hey, Jason. Hello, everyone. Thank you very much for taking time to spend with us today.
Great. Why don't you start off, tell us just a little bit about EGFS, a little bit of background before we jump into the presentation.
Yeah, absolutely. We are an outsourced accounting and financial services company, and we provide basically 4 types of services. We do corporate and individual tax returns. We do company valuations. So for example, for companies who are giving stock options to their employees, they need to be valuing their stock on an annual basis at a minimum to get a fair valuation of the stock. And so we do that kind of work as well. And then the bulk of our work is in the consulting area, where we provide 2 levels of services. One is on the accounting and bookkeeping side, and then we also provide CFO level services. And so, you know, our typical sweet spot is a small or medium-sized company who is either too early or too small to be hiring people full-time or even half-time. And it makes a lot more sense for them to hire people like us, experts, to come in and help them on an as-needed basis, as opposed to full-time, thereby obviously conserving capital and getting what you need from a services perspective. Small and medium-sized companies, we work around the country. But here in the Bay Area, which is where we started, small SMB typically means early stage tech companies, which is our sweet spot.
Great, thank you very much, Sirk. And it's a great segue into what we're going to be talking about today with common startup mistakes. So with the size company that we work with on a regular basis, there are the typical growing pains that come with scaling a company. So some are unavoidable, and it just comes with scaling a company. Some are open manhole covers that you want to try to avoid at all bases. So we're going to talk about more of the latter there. And today we're going to get into what you can see here: lack of preparation, some problems with fundraising, financial issues, infrastructure issues, hiring mistakes, which can really jump up and bite you. And then we've got a couple of recommendations for you to wrap it up. And as I mentioned, we'll do Q&A at the end of the presentation. So use the questions pane in your GoToWebinar console there to get those questions out to us. And we'll get to as many of those as possible. So Sirk, we'll start off with lack of preparation. That seems to get a lot of folks.
Yeah, and when we talk about kind of the common mistakes for beginning a company, this is where obviously there's still a lot of stuff that we don't know, right? We may have a good idea, we may be starting to work on an idea, and we think that there's a lot of potential value there. But this is really the time for us to kind of think about not only the joy of developing something new, but also think towards the future about kind of what this means, right? What kind of a business is it going to be? What kind of resources am I going to need? What kind of fundraising am I going to have in order to be successful? Because if we don't do that kind of business planning initially, then it's going to be very, very difficult for us to kind of react, and we may end up, running out of resources, running out of time. We may not understand what the market is doing and what competitors are doing, or the direction that things are going. And so this is really the time to kind of think through, not only on the product side, but also on the business side, of where we want to be, how we want to point the company, and the direction we want to take our efforts. On the legal formation, this is obviously going to depend, and you need to think through about kind of what kind of company you're going to have. Legal formation meaning, are we going to be a sole proprietorship? Or are we going to be a partnership? Are we going to be an S Corp or an LLC or a C Corp? The things that we want to think about as we kind of think through this are things like, hey, different structures have different types of formations, have different tax implications. There are implications with regards to the level of effort it's going to take and the cost it's going to take to set up different kinds of companies, the amount of legal work that's involved. There's also considerations like, for example, looking forward for future investment, right? If you know that you're going to be going to get outside investors and selling stock, then that probably points you in one direction in terms of how you want to set up the company initially. If it's always going to be a kind of, an individually owned, it's always going to be a lifestyle company, and I just want to make a little bit of money, but I don't think this is going to be anything that's going to, demand investors from the outside, then that's something else, and you may take a different approach. The founders equity grants, I typically tell people not to worry about this at this stage. It'll kind of happen, right? When you talk with a lawyer, if you're setting up a C Corp and you're setting yourself up with different classes of stock and you're giving yourself equity, founders equity, then obviously you're probably looking at some sort of like a corporation, and you'll work with attorneys to kind of set that up. The initial equity grants that you give to yourselves and to founders really doesn't mean a whole lot, because ultimately you own 100% of the company at this point in time, and all that is going to kind of get restructured when you get new investors anyway. So I wouldn't worry too much about that, and I do get a lot of questions about that initially, and I always tell people not to worry too much about it, and you and your legal team will kind of figure it out. On the forecasting and expenses, obviously understanding from a financial perspective what it's going to take, how many people you're going to have to hire, what kind of product development you have to do, when you're going to start seeing revenue, where that revenue is going to come from, how much you're going to have to spend in marketing to get that revenue and to get those customers. All those are things that you have to consider, and obviously try to plan out as much as you can, knowing, of course, that you're never going to be 100% accurate, but at least putting through the effort on the front end will give you ideas, and you'll be able to kind of navigate as you go along and make adjustments. Selecting business partners. This is a key area initially. Where even whether it's banks, finding right lawyers who are experienced in your field is going to be important. Other service providers and potentially partners from a business and revenue perspective. This is clearly a time to start thinking about those things. And then finally, on the intellectual property, if you are developing a product, a system, a process that can and should be protected by IP protection, then this is, the earlier you think about that, obviously the better off you're going to be, to make sure, first of all, that you're protected, and secondly, that the things that you're doing are not also infringing upon other people's intellectual property. So it may be, you may be thinking it's really, really early for me to be thinking about these things or worried about these things, and I wouldn't say that you should be worrying about it, but you certainly should be thinking about it.
Yeah, and going back to like legal formation, just to kind of throw an anecdote of sorts out there for a lot of companies that are looking to seek outside investment from venture firms, angel investors, and the like. Just kind of a rule of thumb is that a lot of them want to see you in or see your company as a C corp. There are the rare exceptions where an S corp makes the most sense, but typically the easiest one, or what seems like the easiest thing to jump into, is right in as an LLC. But as you begin the quest for outside investment, that quest for venture capital, that first big check, keep in mind that a lot of investors are going to be looking for you to be C corp before the first check even comes in the door. So obviously, it's a case-by-case basis. Make sure you do your homework on that sort of thing. Again, this goes back to lack of preparation right there at the top of the slide. But make sure you do your homework and make sure that if you're not already what you believe to be the right business entity, that you're prepared to make the switch or make the conversion if need be.
Yeah, it's even a little bit further than that, Jason. If you set yourself up as an LLC or an S corp, you're actually limited, right, in terms of the type of investors you can take on and the type of stock that you can give out. And so, to Jason's point, if you're looking at any kind of institutional investors who are looking to invest in the equity of your company, they're going to demand that you are a C corp with multiple classes of stock. Whereby they're going to be buying preferred stock, and you as founders, in all likelihood, are going to own common stock. So you have to have multiple classes of stock for institutional investors, and C corp is the way to make that happen. Other types of entities don't give you that flexibility.
Right, and another big one here that you don't want to sleep on, if it applies to you, is the intellectual property piece. So if you think that your product or your service has a vital intellectual property play as part of the success of your business, that is one that you want to address as quickly as possible. So engaging with an attorney that specializes in IP related issues. Even if it's just to have an initial conversation to see what might apply to you, what might not, if you need to start investigating the patent process, or if you need to start doing a patent search to find out if you're infringing on anything else, or copyright search or anything along those lines. That is a black hole that can sink you really quickly if you let that sit too long, and then have to deal with a serious, IP challenge, from a competitor or something similar. So make sure that, if we can underline that one on the slide, that's something that if you think it applies to you at all, to make sure to do a little homework and find out how it applies to you specifically.
Yeah, have an initial conversation, right, with an IP attorney. You'll find that it can be very, very time-taking, and it can be very, very expensive, to really do it right. But there are ways that you can mitigate some of the risk initially, and do it in a cost-effective manner. But yeah, absolutely, I agree with Jason, and you should have that discussion with an IP attorney if you think at all that this might be an issue for you.
And real quick before we move on, if anyone has questions or would like to speak with an IP attorney or a startup-focused lawyer or law firm about what their business entity might be, if you need some names, we're happy to provide those. So we work with those types of firms in a regular basis in all 6 markets that we service in the United States. So we've got our contact information at the end. If anybody needs an immediate reference of sorts or a few references, reach out to us. We're happy to help you out there. So a little plug before we move on. Let's just jump into the fundraising blunders. And this is another one, Sirk, that can bust you pretty quick if you're not careful.
Yeah, that's very, very true. I would think that most people who are joining us today, if it's kind of like really early stage and you're looking to avoid common mistakes, you may be a first-time entrepreneur, you may be, or you may have already done one before. obviously valuations and fundraising becomes a key thing. Everyone always wants to ask, well, how much is my idea worth? How much, can I raise, based upon, what I've done to date and what the market size opportunity is? How do I figure all that stuff out? And, I'd say the first blunder that people make is people worry too much about it, or they focus too much of their efforts on it. Because, as far as fundraising and valuations in particular are concerned, they almost kind of drive themselves. They drive themselves from the standpoint of, when you go out to raise money, how much have you accomplished? What really is the market opportunity? How well are you able to communicate that, to potential investors? How big of an appetite is there from an investor standpoint? Valuation is one where it's like, if you find one key investor who's marginally interested, even though the idea may be absolutely fantastic and you may have made progress, you're going to get one set of valuations. And if you have 3 or 4 investors who are really, really hot to get in on it, then you're going to have a completely different valuation, even though it's the same exact company, you made the same progress. So, valuations will take care of themselves. What you kind of want to think through is at the very, very initial stages, how are you going to fund, right? How are you going to fund the initial efforts, right? So is it going to be, are you going to be putting up your own money? Are you going to be borrowing money from friends and family? Are you going to be taking out bank loans? Are you going to be, putting credit on credit cards and other loans? Are you going to be taking out a second mortgage? Initially, you're going to want to do everything that you can to make as much progress as you can by yourself with the funds and the investment that you're able to garner before you actually go out and talk to VCs and angel investors and even crowdfunders, for example. The more progress you can make and show before asking others for money, the better off you're going to be. On the funding structure, and the funding objectives, this is again kind of, it kind of depends, on the company that you have, the opportunity that you have, what kind of revenue model you can show, the ability to support that, the product development that you've had to date, and any kind of data that you can show to convince people that you're going to be successful and that you're already on your way to success. That's going to kind of determine what the structure is going to look like. People always ask me initially, well, what kind? Are we talking about debt? Are we talking about equity? Or what should we be looking at? I think the main thing is for a lot of early stage companies, even if you're ultimately going to do some sort of an equity round of financing, a big Series A VC round of financing, a lot of companies start with something much easier, something like convertible debt, which is basically someone invests some money. It's on your balance sheet as a debt, but it's ultimately going to convert into equity. But what you're doing by doing this at an initial stage is it's much easier to paper, much fewer negotiation points. It's a several page document instead of a several hundred page document, which is what an equity round of financing is going to take. And it kind of punts the discussion of valuations down the line. This presentation probably isn't the best vehicle to kind of get into the depths of fundraising and different types of fundraising. We have other webinars which focus on that in particular, so we won't go into it here. But
yeah, we've got an entire webinar around just this one topic and this one slide, right? So
well, several of them, right? Like, we have one or more on convertible debt. We have one or more on initial fundraising efforts. So there will be other opportunities for us to dive into really, really great detail on that. But just know that when you're first starting out, the main things are that there are different funding options out there, and you obviously need to think through kind of what the potential roads are for you. And then hopefully plan it so that you're able to be successful in the road that you take.
Great. So one piece that we'll talk about just as far as pitfalls go, like there on the end with the investor management, as we've kind of just touched on, like we've got a couple webinars around fundraising. We've written many blog posts on this kind of topic, but one thing to touch on with the investor management is again, it's about preparation and doing your homework, right? So blindly blasting out your pitch deck to 250 investors that you've scooped up email addresses for, or walking around with a printout of your deck to just hand out with your business card to any investor you meet. You're playing kind of the scattershot game, and sometimes that pays off, but rarely. So doing your homework on the type of investor that you need, that your business needs, and finding the type of investors that invest in your stage of company, your type of company, the industry that you're in, even just doing some cursory background on what type of money you want coming into your business can really take you a long way as far as preparing for your first round of fundraising. So keep that in mind as you're putting that together and figuring out who you're going to go after in terms of investment dollars. So.
Yeah, that's a really good point, Jason. Clearly, if you've got if you're working on a big, software as a service model, for example, you got a great idea that's going to take a year and a half to develop. You're not going to go out and crowdfund that, right? Likewise, if you're kind of trying to develop a relatively low cost consumer product, for example, that may not be the best investment for VCs, right? VCs typically don't invest in those kinds of products or ideas, and so kind of putting the investor group together that would make the most sense for your company, both at the stage and the type of company and product that you're developing, is obviously going to be helpful. Don't take a shotgun approach.
Nice. So moving on, we'll get kind of the meat and potatoes of what you deal with on a daily basis, Sirk, and talk about kind of the financial side of things.
Yeah, and so on the front end, even before we get into the pitfalls of actual financial issues, clearly, again, to reiterate my earlier point about planning properly, right, and to make sure that we understand. And when I say understand, I don't mean like you need to dot every I and cross every T, but in broad strokes, understand kind of what it's going to take. Right. The last thing we want to do is to just have some, kind of like a high level idea of, what, hey, this may take, it may take $30,000 or $40,000 a month for the next 6 months. And then you realize once you start getting into it that it's going to take a whole lot more. Then those are the things that as you get to understand your business, you need to hone that model and need to hone the assumptions based upon that's driving that model as often as you get more information. But clearly, at the early stages, cash management is going to be the most important thing, right? Is where are you spending your money? How much money do you have to spend, first of all? Where are you spending your money? Is it the best? Is it the best place to be spending your money? Can you do things cheaply? Does it make more sense to invest, right, in certain things? Only you can kind of make those determinations as to the best decisions that you could be making for your company. You can ask people for help, and others will obviously provide guidance and advice. But it's really up to you to make those decisions about where you need to be spending your money, and you need to be watching it, right? You need to be watching, where your cash goes, and making sure that you're achieving the things that you need to achieve, with the money that you spend. On the checks and balance, this is, this is where I've seen some companies get into issues early on. They don't put in checks and balances. They hire a few people. They have one person who's kind of responsible for everything, including writing checks and actually signing up service providers, right? And then that person ends up just kind of going off the grid a little bit and signing up for things that ends up, being not the best use of money. So, we always say you should always have, again, for cash management in particularly, you should always have, two people involved at a minimum, right? One is, person who's making the decision to spend money, and another person who actually disperses that money, and that should be kind of a check and balance. Obviously, if you're a sole proprietor or you're just the CEO, founder that's getting started, then you're making all the decisions, and clearly that doesn't apply. But as you start to grow and as you start to hire people, make sure that you put in the checks and balance so that you don't get burned on the back end. The cash burn, right? So this is one that's obviously near and dear to any CFO's heart. Working with early stage companies who typically are losing money, right? We're burning money, and knowing how much we're burning, knowing our runway, right? We say runway, which means that how much time do we have before our cash runs out and we run out of runway. Knowing that number and that date is critical, right? At all times, you should know exactly, with where we are today and what we know we're going to be spending money on, how much cash do we have, right? And when do we need to start the effort of raising more money or changing the direction of our company, whatever it may be. And as you make changes, if you start ending up spending a little bit more, or if you end up having to hire someone, to take over a critical function, for example, then understanding what that does to your cash burn and how that may shorten your runway is going to be critical, because the last thing that you can afford to do is run out of cash, right? Everything else, every other thing that goes wrong, we can actually recover from, right? You run out of cash, we're dead.
Very good, strong way to end that that piece right there, sir. Thank you very much. And it's never too early to at least get some guidance from a financial perspective, right? Like, a lot of folks that we work with, whether they're MBAs or engineering students or something else extraordinary, like most folks we see and talk to at least have a basic understanding of finances and how to keep things above board. But there's a time where this stuff gets away from you, right, Sirk? So it's never too early to at least reach out and have a conversation, just like we talked about with the IP protection and with the the business entities, at least to find out where you stand and whether you need to get experts involved.
Oh, absolutely. I've had several discussions with entrepreneurs who reach out and say, "Hey, Sirk, I've listened to a couple of your presentations, and I'd like to just ask you a couple of questions about my situation." And after spending 5 or 10 minutes with them, my recommendation is, hey, you're doing all the things that you need to be doing. No need for you to be looking at outside help. Don't worry about things like putting together a big accounting system. But here are a couple of things that you might do, right? Just get yourself set up properly with a right bank. Don't commingle your personal expenses with business expenses. Set up a separate bank account. Don't worry too much about a lot of accounting principles. But if you know you're gonna be around for a little while, and at some point you're gonna need to capture accounting data, use something like QuickBooks Online. Xero with an X is another online accounting service that's gaining in popularity. Although as financial people, we much prefer QuickBooks just because it's a little bit more robust. But it's very, very cheap system, right? And we'll talk a little bit about that on the next slide. But yeah, this is talk to people. If this is an area, if financial and accounting is not an area that you're perfectly comfortable in, then just reach out and talk to a few people and get some ideas.
Great. So let's jump into the next slide and talk about infrastructure, where that house of cards can crumble pretty quickly if you don't have everything set in place correctly.
Yeah, and this one's becoming much easier, right, than in the past, and it's becoming much easier because there has been a tremendous growth and a move for early stage companies to use external resources for some of these things, right? 15, 20 years ago, it was a lot. It was kind of hard to get some of this stuff, in place without, without resorting to setting something up internally. But now all of this stuff, right, can be done, very, very cheaply by professionals who you can leverage on an as-needed basis, as opposed to hiring people internally or buying a whole bunch of systems, for your server room. So obviously, on the accounting and finance infrastructure, we are, clearly believers in outsourced. All of this stuff really should be outsourced, but we are clearly believers that there are professionals like us who assist companies at an early stage. The last thing you want to be doing as an entrepreneur is worrying about, about spending a lot of money on the back office stuff, right? So, you don't want to be hiring an accountant. You don't want to be hiring bookkeepers. This stuff can be done literally, a couple of hours per week by a professional for next to nothing, and it'll keep your books in shape. Banking, obviously, you should be thinking about working with the right banker. Again, to reiterate, the key thing that you can do at the very beginning is making sure that you don't commingle your personal expenses and your personal transactions with business transactions, right? So set up a bank account, get a corporate credit card, even if it's more of a debit card because you don't have credit, your company doesn't have credit, but get something set in place so that you don't have to worry about going back in the past and saying, boy, I remember spending a bunch of stuff on my personal credit card that was a business expense, and now I need to reallocate or recategorize that. You don't want to be doing that. Plus, there's some legal issues in terms of liability that you open yourself up to if you commingle those two things. HR, kind of same thing. There are lots of companies out there now who provide outsourced HR services for early stage companies, and you should absolutely be leveraging those. And to Jason's point earlier, if you are looking for introductions or people who do this, we'd be perfectly happy to provide a couple of names for you to reach out to. Legal infrastructure, same thing, right? You're going to be working with a lawyer. I highly recommend. This is an area that I know it's money out the door. But I've also seen people make the mistake of saying, hey, I really don't want to spend money on legal, and so I'm just going to kind of work with this small lawyer that I know or that my dad knows, and he's going to help me set up the company and help me on the legal side. And especially if you're a company that is that's going to be growing and potentially taking outside investors, doing things on the front end properly is going to be really, really critical. And so don't skimp. Talk to a couple of lawyers. You can figure out ways to actually limit how much you spend, but don't do it by finding someone cheap. This is an area where I think that finding the right counsel is going to be really, really critical to you not making an early mistake. And then IT infrastructure, kind of the same thing now. Before, people would buy servers and email systems and all that, right, and do it internally, right? And now there's just no need for that. Everyone is going paperless, cloud-based. So Google. We internally at Early Growth, we use Google for almost everything. A lot of our clients use document repositories like Google or Dropbox or Box. We use accounting software online like QuickBooks Online. Obviously, AWS or Amazon Web Services for cloud-based servers. Basically, all of this stuff now, there's just no need other than you buying maybe a couple of laptops for yourself and your partner. There's just no need to invest at an early stage in a lot of infrastructure. There's a lot of guys out there who are going to be able to set it up for you or already have something set up that you can use on day one and not spend a lot of money and not commit a lot of resources.
Right. Yeah. So, as Sirk touched on, yeah, again, if you have questions or need like some names, some companies in any of these areas, like reach out. We can put you in front of a few different people in each of these areas. And as he mentioned, it's easier than it's ever been before. But that's if you are focused and if you've done the preparation and you've made the right choice on solution. Otherwise, a couple examples, or the example of the dad's golf buddy kind of thing that can help you set up your accounting function or help you set up your business entity. When you kind of skimp on some of these services, you end up getting what you pay for. So be very careful. And with any one of these areas, if you end up being caught behind the eight ball, like getting proper HR infrastructure in place after you've hired, or the wrong business entity in place when it comes around to tax time, or IT infrastructure there's several different scenarios that can be horror stories really fast. So again, we keep harping on preparation, but taking a look at each of these points is going to be a huge advantage for you looking forward in the long run. So kind of jumping forward, speaking about HR, and this is a very important one, Sir. Let's talk a little bit about hiring mistakes specifically.
I personally think this is the key one, and this is the one where I think I see, probably not the most mistakes that are being made, but maybe the most critical mistakes being made, and that has to do with hiring, and the people that you bring aboard. And there's so many different ways that you can make mistakes here. So again, obviously, thinking through kind of what your needs are, when you need to bring people aboard. Obviously, you don't want to wait too long, but at the same time, you don't want to hire early either. Obviously, that's a waste of money, and not only that, but then people don't have anything to do, or the wrong thing to do. So thinking through what your needs are, right? If you're a founder. If you're a founder who has a great technical idea and you have a technical background, and you're developing a service or a product, a tech service or a product that you think is needed, then you're going to probably be thinking about, okay, I'm the technical guy, right? Maybe the first person or the next key person that I'm going to be bringing aboard is either an operations guy or a business guy, a sales guy or a sales/marketing guy. Business development, and that may be kind of the right partner to bring aboard, as you kind of start to grow the company and think about, being successful. Obviously, if you're an ideas guy and you're great at pitching, and you're kind of a big strategic thinker, but you need some help on the technical side, to make sure that what you have in mind can be done, and bringing the right person aboard to make that happen is obviously critical. So clearly, that's the easy stuff, right? If you're a tech guy, you need to bring on a business guy, and if you're a business guy, then you need to bring on a tech guy if it's a tech company. So that's clearly, I think that's obvious. But the kinds of mistakes that we see being made are things like, I want to hire someone who's really, really knowledgeable about this industry. And so then we end up hiring someone, who has a great looking resume, has worked in companies that are tangential to our space, and on paper looks really, really great. And they talk a great game when you talk with them. But it's not necessarily the best fit, because we may be talking about a person who thrives more in a kind of a bigger environment, right? Maybe there's somebody who is adept at taking a $100 million company and turning it into a $1 billion company, right? When initially what we might need is someone who can really roll up their sleeves and get down and dirty and be able to get things done, even though there isn't a lot of infrastructure in place or a lot of processes in place. Just kind of more of a startup mentality. And that's one mistake that I see being made a lot, is people get kind of infatuated with resumes and hire someone who sounds great on paper but isn't a great fit for what we're trying to achieve at the time that we're trying to achieve it. And so that's the one thing that I always ask people to think through before they make a big hire. But these bullet points that you see on this slide obviously are critical. We're big proponents of hire slowly and fire quickly, right? Which means that when you're making a decision to hire someone, really think it through, talk to different people, think about how this person is going to integrate with the current team that you have or what you're trying to achieve. At an early stage when there's only a few people in the company, right? Communication style, personality, right? Those things are going to be just as important as technical expertise or industry expertise, right? Being able to work well with each other's, being able to work well into the night, and not grate on each other's nerves, or just not want to go to work in the morning with that person is critical, even if that person has been successful in the past. And because once you hire, right, it's a costly endeavor. It's a costly endeavor to hire, and typically it's a costly endeavor to get out of a relationship with an employee as well. And so, making the mistake of hiring the wrong person can be very, very painful. So hire slowly. And on the back end, right? I've seen entrepreneurs who hire someone, and even in the first month, right, it's clear that something's off, right? It's clear that they don't think the same way we do. It's clear that they ask questions like, well, what kind of health insurance are we thinking about for our company? Or, I'd love to bring on this marketing firm that I've worked with in the past. And whereas we as entrepreneurs are thinking, healthcare, that's the last thing on my mind, right? We just need to focus and get this product completed. Or, marketing firm, what are you talking about? We're the marketing guys, right? We need to be doing things. We need to be bootstrapping this and using guerrilla marketing and knocking on doors as opposed to working with a marketing firm. And so though you start to see those kinds of things and bad fits, and I've seen entrepreneurs get into the mistake of, well, maybe it'll work out, or maybe we'll grow into it, or maybe that other person has some viewpoints that make sense, and I should be considering. And invariably, or certainly more often than not, that ends up being a mistake, and we end up severing the relationship, and we end up severing the relationship months longer than it should have taken. And when we know that it's a bad fit, we should be willing to recognize that and correct our ways, sever the relationship, and use that as a learning lesson to hopefully hire the right person the second time around. So do it quickly. If you know it's a bad fit, then sever the relationship as quickly as possible. And that goes for even lower level guys, right? Sometimes we think, hey, listen, this person's got a technical skill, and I'm gonna learn to live with it. Well, invariably those types of bad fits end up kind of permeating throughout the organization as you grow. So we caution you against keeping people aboard longer than they should if there's a bad fit. On the compensation side, obviously we get asked this a lot. Well, we're an early stage company. Can we offer less? What about stock? What kind of stock do we offer? Stock compensations. And here's a chart here with some equity ranges for relatively early stage type of people that we would bring aboard. But I wouldn't read too much into this. These are just kind of ranges for talking points. We find that clearly the compensation, what you're able to offer, differs, right? Differs in terms of the markets that we're in. Clearly, the same person that we hire in San Francisco is going to cost more than someone we hire in Chicago, for example, even though Chicago is not that cheap either, but San Francisco is just much more expensive. Depending on how hot the talent is that you're trying to get, or how hot that technical expertise you're looking to hire, obviously, it's going to cost more. So compensation, there's lots of compensation studies out there. I would do a little bit of research online. You'd probably be able to find some of that stuff. And also talk with people, some of your partners, right, that you're working with. Talk to the bank that you're working with. Talk to the attorney that you're working with. They'll probably have compensation studies and give you ideas of what you might have to pay for certain types of people. But it's a key one, and you're going to need to think through again, who the right hires are, and when do we need to be bringing them aboard.
Now, Sirk, what are your thoughts, or what's your experience been with hiring family or close friends? Have you seen a lot of that, or have any kind of advice one way or the other on that particular group of people? Because that's we see that a lot. So
we do.
Is that something you recommend, or maybe be wary of? What are your thoughts there?
Definitely be wary of. I don't recommend it, in general, right? In general, I don't recommend it. There's several key reasons for that. I'm a firm believer in in separating business from family, just because of families forever, right? And businesses come and go, money comes and goes. But what happens if you have a falling out, right, with a family member at the business, right? Well, okay, the business might not do well, but now you've got an issue where you're having a battle or a war with a family member that's going to last your lifetime, and you're probably taking on more risk than you need to for that. Purpose. Now, if it's really kind of like a partnership, and it's you and your brother, or you and your wife, or your husband, who are looking to start a venture, clearly that's something different, right? But we definitely shy away from you starting a company, getting it going, and then starting to hire family members to take on roles. And I guess without getting into politics, but you can kind of see some of the issues that Donald Trump is having right now with some of the family members, and what people are saying about that. But and then there's another side to it too, right? Because if we got the kind of company that ultimately where we're going to grow it and we're going to get outside investors, it's going to become an issue. Right, it's going to become an issue when an outside investor comes aboard, and they're going to want to look at the employee list, and having family members in key roles at the company is going to raise questions. And for investors, what you want to do is you want to make it as easy as possible for an investor to say yes, and you wanted to make it as hard as possible for an investor to say no. So take away as many of their objections as you can. You want to take away their objections from a market size perspective. You want to take away their objections from are we the right, do I have the right technical skills? You want to take away the objections from you don't have enough traction, or you haven't shown that you can get the traction. So all those things, as you can knock them off one by one, is going to make it easier for you to get investors to sign on the dotted line. The last thing you want to do is to add to the list of objections that they might have, and having family members at your company is absolutely one of those objections.
All right, great. So let's kind of wrap it up here with some final thoughts. I know, Sirk, you and I talked about this a little bit yesterday, but from Eric Ries's book, The Lean Startup, which we've gotten our recommendations there, but be nimble, right? Be ready for change.
Yeah, and here's a couple of books that we highly recommend any first time or second or third time entrepreneurs to read if they haven't. Great ideas, thought leaders in the space, and will put you on the right path to start with. But in particular, what I like to tell people is, no matter how well we plan, right, it's going to be different, right? It's going to look different 6 months down the line, 1 year down the line, from what it looked like before we started. And I always tell people, and we're going to make mistakes. There's no ifs, ands, or buts about it. We will make mistakes. We will go down the wrong path, and we'll need to correct. And what we need to make sure that we do is that we're always ready, right? We're ready with new information. We're ready to absorb the information. We're ready to admit that we went down the wrong path. And before we go, miles down that path, let's go a couple of 100 feet and let's, go back, right? Or let's branch off, right? And let's make sure that we're being nimble and ready to make changes. We in this space, in the startup space, the word pivot, right, is a key word, right? We use that all the time. Investors use that all the time. Entrepreneurs use that all the time. We will pivot our business and the way that we think, and the market that we're going after, the product development, right? We may decide that 6 months in, as we're developing this great software, that we need to make tweaks. The sales model may be different, right? Instead of an enterprise model, it may become more of a consumer or a business to consumer model. As time goes, as we get more information, as we learn more, not only about ourselves, but our competition, the marketplace, what others are doing, what's getting funded, right? Getting an idea of kind of the types of companies that are getting funded, can and should make a difference or be a factor in how we move forward as a business. Yes, we want to say, look, this is the way it is, and this is the best approach, and I know it is, but typically that type of attitude is one that's harder to fund from an investor standpoint. Being open-minded, being ready to make changes, being able to pivot is a key trait that will serve you well now and in the future.
Yeah, and we don't normally look to Mike Tyson as a font of wisdom, but there's that saying that's been attributed to him for years that everyone has a plan until they get punched in the face. So that's one particular way of looking at this. And anybody that's played football growing up, you've had a coach yelling at you probably about the 6 Ps, which we've got there on the screen for you to kind of remember. But it goes back to that very first slide that we jumped into here about preparation. So a couple of books that we've got there that you have probably seen or heard of in some form or fashion. The Lean Startup, that's been a big seller for entrepreneurs and founders for years now, from Eric Ries. And then one that we like to recommend pretty regularly, The Art of Start from Guy Kawasaki, the first PR guy for Apple way back when, started Garage Ventures many years ago. He's a big influencer in the tech world these days. He's actually out in second edition now, The Art of Start 2.0. So definitely 2 good books that you can kind of jump into and read if you have the chance. I think there's going to be a lot of stuff for any of you listening today that's going to be super helpful. Kind of jumping over to the Q&A. I know we've got a few minutes here for questions. Again, we've got the questions pane in your GoToWebinar panel. So we've got some questions that have already started to come in. So we'll hit as many of them as we can here in the next few minutes. If we don't get to your question, our contact information is right there. We encourage you to reach out, whether you've got questions from the webinar, or if you want an introduction to one of these service providers that we talked about. Happy to do that. It doesn't cost you a thing. Just swap a few emails and it's done. So that's our information there. Sirk, let's kind of jump right in. A great question that came in is around mentors and advisors. Do you typically see, and I already know the answer to this, but giving any kind of initial equity to advisors, what do you typically see or recommend there?
Yeah, we do. I mean, it's kind of, if you're Yes, the answer is, if they're really key advisors and they're doing more than just kind of helping you and get started. If they're industry experts that you're going to be able to go to for advice. If they are high level advisors who again you're going to be able to go to on a regular basis, you absolutely can and maybe should give them a small equity stake. Whether that's in the form of stock or in most cases some sort of an option that is earned over time. So that you kind of keep them on board with an agreement that says that they'll provide advisory services for 6 months, 12 months, whatever it may be, and that they earn their small equity stake over that time period. Then yeah, absolutely, that's appropriate. But a lot of people are, especially if you're really early stage and you don't even have equity into the company at this point. A lot of people will kind of do that for you to help you get started, understanding that as you grow that there'll be a bigger relationship going forward. But yeah, if they're key advisors, absolutely no issues with giving them equity if they're going to provide value and increase the value of your company.
Nice. An interesting question that came in, and I'll throw it out here because I don't think I've seen it asked before in my travels, but convertible notes. Have you ever seen like a friends and family convertible note?
Sure, absolutely. No issues at all. So, so for those of you who don't know what convertible notes are, convertible note is basically where at an early stage, someone wants to invest in your company. They know that it's they want it to turn into equity at a certain stage, but we don't know what in order to do equity, you have to have a valuation and you have to have a whole bunch of paperwork. You have to have a consortium of investors. Doing an equity round of financing for a small amount of money doesn't make sense because the legal fees are going to cut into it. And so you do just a very simple convertible note where someone lends you money and there's 3 or 4 terms only, and at the end of some equity round of financing in the future, that convertible note plus any interest that's been earned over that time get converted into the equity in the next round of financing. Absolutely, we see family members doing that, as kind of the initial or an initial set of financings.
And the fact that they're not accredited, that has no issue with setting this up? Not an accredited investor?
Yeah, so if they're, so first of all, I'd be a little bit careful. Yeah, at some point, they're going to, if it's going to turn into an equity round of financing, they're going to need to be some sort of an accredited investor. If they're not an accredited investor, I'd say rather than the technical part of whether they're accredited or not, I'd say there's a bigger issue, right? Which is that, do they understand what they're doing, right? Again, friends and family, mixing family with business is an area that you just want to be careful about, right? When you say they're a family member and they're not an accredited investor, do they understand what a convertible debt loan to an early stage company means, right? Because a lot of people think of themselves as, they say, hey, this is debt, this is a note, I'm going to get paid back, right? No, convertible note is not going to, is in almost all cases not going to be paid back. It's either going to turn into equity or it's going to be lost, right? One or the other. And so, does the family member understand that first and foremost? Because if they're not an accredited investor, then that would be my first concern, is do they understand what they're getting into? I in terms of the actual technical accredited versus not, I don't remember the exact rules of how much of an investment it has to be before someone has to become accredited. I think a quick search online would be able to kind of give us that number. But in most cases, for equity rounds of financing for early stage companies, you're going after some sort of an accredited investor.
All right, so let's jump into one more question here before we wrap it up. Had actually a couple questions around this this kind of particular topic, but founders agreements. Like, how soon should founders put something in writing? Should they involve a lawyer? Like, what do you typically see or recommend in that instance?
You should. Yeah, I mean, the earlier the better, right? And you know, if you're talking about you know, two or more people kind of starting a company initially, then you can obviously get started without any kind of an agreement. But as soon as you know it becomes clear that there's something there, that it's something that you want to move forward with, and you want to get, you know, not only commitment from each other, but also an understanding of each person's roles and the amount of equity that they're going to have, then you want to put it in paper. You want to put it on paper. You want the agreement in place. And quite frankly, you know, ultimately, when you go for investment, they're going to want to make sure that investors are going to want something in place as well to make sure that there's commitment on the part of the founders, because the last thing that investors want to do is to invest in a company assuming that there's two or three key guys and then only to have one or two you know, not go along for the ride afterwards. So yeah, you should do it as early as possible. Again, have a quick discussion with an attorney to figure out what it would take. It doesn't take much to put something together. There's typically, you know, templates that are already in place that most law firms that work with early stage companies already have that in place. It's not going to cost you anything to just actually take a template and change names and amounts around to get something in place.
Okay, awesome. So we will wrap it up there. As I mentioned, our contact information is on the screen if you have questions that we didn't get to today. So a recording will be made of this and sent out within 48 hours, or you can check on our YouTube channel, Early Growth FS, for a recording there as well. Sirk, I'd like to thank you for joining us today. Any parting words?
Yeah, absolutely. Thanks, Jason, and thank you all for joining us. And I know we talked a lot about kind of mistakes that we make early on and how to avoid them. But probably the best advice I could give you is jump in, right? I mean, if you've got an idea, don't let these kinds of issues or concerns keep you from doing what you want to do, which is hopefully making a big impact on our community, on our world, and hopefully yourselves as founders and entrepreneurs and successful ones at that. So, you know, we commend every entrepreneur who goes out and tries to make a difference, and any kind of, you know, message or warning messages that you hear from the likes of, you know, conservative accounting and finance folks like me shouldn't keep you from jumping in.
Wonderful. Thank you very much, Sirk, again, and thank you all for joining us today, and have a great rest of the week.
Take care, everyone.